There's a pattern buried so deep in the economy that Wall Street prays you never spot it. Schools skip it. Your 401k guy won't whisper a word. CNN, Fox, they act like it doesn't exist. Yet this exact rhythm called the crash of 1873 nailed 1929, screamed 2008. And right now it's blinking 2026 in neon red. Not 2027, not someday, 2026. The math is brutal. The track record is 200 years without a miss. And if you get this today, you'll smell the smoke months before the fire department shows up. This isn't tinfoil hat stuff. It's seasons, economic seasons that roll in like clockwork. Spring growth, summer boom, autumn plateau, winter wipeout. Discovered in the 1920s by a Russian genius named Nikolai Kondratiev, spelled Kondratiev, but we'll just call it the K-wave for short. He pored over price logs, interest rates, factory output, commodity swings going back to the 1700s. What he found? A long, slow heartbeat every 40 to 60 years. 4 phases. Always, no exceptions. Stalin hated the message permanent communist prosperity? Yeah, right. Kondratiev got tossed in a gulag in 1930, froze to death in 38. But his wave kept ticking. And folks, we are neck deep in winter, the phase that always, without fail, ends in a crisis. Visual on screen, a simple sine wave labeled Kondratiev long wave, spring green, summer gold, autumn orange, winter ice blue. We're sliding down the right side of that blue cliff right now. Think it sounds dramatic? Good. Drama keeps you alive when the market's bleeding. Because the same Fed that's swearing soft landing just watched U.S. federal debt hit $37.1 trillion in October 2025, up $1.2 trillion in the last 12 months alone. Interest payments, $1.27 trillion a year, and climbing faster than your HOA fees. That's more than defense, more than Medicare. The biggest budget line is now the bill for yesterday's borrowing. Sound familiar? Quick rhetorical gut check. When was the last time your paycheck grew faster than the interest on the national credit card? Comment, never, if you're with me. But I'm getting ahead. Let's walk the cycle so you can see exactly where your money sits today. Phase 1. Spring. The hangover cure after winter's bender. Debt's been torched in the last crisis, so balance sheets are clean. Interest rates low, prices stable, optimism cautious, but rising. Post-We America, classic spring. 1,952nd suburbs exploding, interstate highways snaking coast to coast, black and white TVs in every living room. Inflation, a tame 2%. You could buy a house on a factory wage and still take the family to Disneyland. Visual, grainy footage of Levittown homes going up. Ike waving from a convertible. Then summer hits. The tech from spring goes viral. Jobs everywhere, wages climbing, confidence off the charts. 1960s space race, muscle cars, manufacturing humming. But under the hood, debt creeps up. Inflation wakes up. Everyone's convinced the party never ends. Autumn rolls in. The plateau nobody wants to call a peak. Growth slows. Inflation rages. Central banks slam the brakes. 1,972nd stagflation gas lines, 13% mortgage rates, unemployment and inflation both in double digits. Speculation replaces real investment. Asset prices detach from planet Earth. Visual, chart of S&P 500 P or E ratio today at 38, higher than 1929's 32 peak. Caption flashes, this is not normal. Winter, the reckoning. Debt mountain collapses. Bubbles pop. Banks fold. Unemployment spikes. Deflation or depression purges the rot. 1,930 seconds. 25% jobless. Stocks down 89%. Took 25 years to get back to break-even. That's a full K winter. But here is the plot twist that changes everything for us. 2008 should have been our winter. Subprime Lehman died. The system teetered. Instead, the Fed hit the nitrous zero rates, QE infinity, trillions printed. They didn't cancel winter. They hit snooze. 15 bonus years of fake summer. And now, the alarm's going off. Visual, side-by-side debt to GDP charts 1933 at 260%. Today at 343% globally per IMF October 2025 update. Red arrow screaming upward. Question for the moms watching. If your family budget ran 343% of income, how long before the bank forecloses? Drop your guess below. 3 monster cycles are high-fiving in 2026. Miss one? Maybe we skate. Miss all 3? Buckle up. Cycle number 1. Classic K-Wave. Peak to peak average 56 years. Last autumn to winter handoff. Late 1960s. 56 years later equals 2024 to 2026 window. Cycle number 2. Debt super cycle. Max leverage every 75 years-ish. Last top 1933. 75 years equals 2008. We delayed it with QE. Interest on U.S. debt alone now eats 19% of federal revenue, highest since 1996, per Treasury October 2025. Cycle number 3. Generational forgetting. Every 84 years, the folks who lived the pain die off. 1929 plus 84 equals 2013. 1933 plus 84 equals 2017. We ray the generation with no scar tissue. We think 401ks only go up. Visual, 3 overlapping circles converging on 2026. Caption, perfect storm forming. Leading indicators are screaming. Yield curve inverted July 2022, longest on record. Uninverted September 2024. Recessions hit 6-18 months later. Hello March 2025 to March 2026. Corporate credit spreads widening since Q4 December 24, 2023 month lead time points to Q4 20 to 5 Q4 2026. Money velocity peaked Q1 2022. Down 18% since 24-36 month lag says crisis door opens any day now. Household debt service ratio crossed 15% of disposable income in Q2 2025 Fed's own data. Every prior crossing triggered recession within 18 months. Clock runs out December 2026. Commercial real estate, $1.8 trillion refinancing wall 2025 to 2027. Peak Q1Q to 2026. Loans written at 2.5%, now rolling to 8%. Office vacancy in major cities hit 21% per CBRE September 2025. Regional banks hold 70% of these loans. Defaults cascade credit freeze. Here comes winter. Visual, animated waterfall of maturing CRE debt. Red blocks piling highest in spring or summer 2026. Real American gut punch. Meet the Miller family, Youngstown, Ohio. Dad lost his steel job in '09. Refinanced the house at 3% in 2012 to start a trucking biz. Business boomed until diesel hit $5.5 in 2025. Now, the note resets to 7.75% next March. One late load, and the bank owns the house. They're not numbers, they're your neighbor. Comment Miller if you know a family one paycheck from the edge. Your brain is the real risk right now. Kahneman proved it. Loss aversion makes a 10,000 paper loss hurt twice as bad as a 10,000 gain feels good. That's why folks rode pets. Calm to zero, and we'll ride today's AI darlings into the teens. Psych hack number 1. The 2% rule. Every Sunday night, move 2% of your portfolio to cash or short-term treasuries. Tiny, painless, compounds to 50% liquid in 6 months. Beats panic selling at the bottom. Visual, calendar animation, green checkmark stacking. Hack number 2. Anchoring antidote. Hack number 3. Winter war room. Create a private doc titled 2026 buy list. Add one distressed asset idea per week. Farmland ETFs, closed-end muni funds, whatever. When panic hits, you shop the list, not the headlines. Real story. Sarah, single mom in Tampa, followed a version of this in 2009. Paid $42,000 for a foreclosed condo at auction. Sold 2023 for $315,000. College paid, retirement seeded. She didn't time the bottom, she just refused to anchor to 2006 prices. Question: what's the one asset you'd snatch at 50 cents on the dollar? Drop it in the comments, I read every one. 2008 had a real estate bubble. 2000 had tech. 1929 had stocks. 2026, we inflated everything at once. S&P up 550% since 2009 low. Bonds at negative real yields for a decade. Crypto from 0 to $3 trillion. Even Beanie Babies 2.0 sorries hit $40 billion. There's no bomb shelter when every asset correlates at 0.9. Zombie companies, firms that can cover interest with earnings, now 20% of Russell 3000 per Deutsche Bank Q3 2025. Rates stay above 4%. Mass extinction event. Government debt math. 37. 1T federal. 1 2070 annual interest. Fed funds at 4.25% today. If inflation forces another 1% hike, interest eats 25% of revenue by 2027. Only 3 exits: default, inflate, or austerity. History says they'll pick inflate stealth tax on your savings. Visual: pie chart of federal budget interest slice, now bigger than defense. Slice grows in real time. Trigger sequence: late 2025 first big cray default cluster. Q1 2026 regional bank stress tests leak failures. Spring 2026 credit spreads blowout past 2008 wides. Summer 2026 Lehman 2.0 invention, fake rally. Fall 2026 secondary collapse, unemployment to 10% plus. 2027-2028 bottom forming. Don't memorize dates, memorize phases. Crack contagion intervention, secondary collapse reset. Action beats prediction. Start tonight. Cash is king, target 12 minus 24 months expenses. Park in 3-month T-bills yielding 4.1% today. Zero risk beats inflation. Debt is dynamite, kill high interest first. Average credit card APR hit 24.6% per Fed October 2025. Payoff equals instant 24.6% return. Stocks trim to 40-50 allocation if you're over 60%. Keep quality utilities, consumer staples. Let cash earn while you wait. Real assets 5-10 in physical gold or silver via reputable dealers. Not speculation insurance. Skill up. Learn one recession-proof trade. Plumbing licenses issued in Texas up 38% since 2023. Cash businesses thrive in winter. Visual: checklist graphic. Green checkmarks appearing as each item is spoken. Final psych note: the crowd will mock you in 2025 for missing the rally. They'll beg for your cash in 2026. Print this script, date it, tape it inside your safe. When the headlines scream unexpected crash, you'll smile because you expected it. The cycle doesn't care about your politics, your age, or your feelings. It just turns. Winter's coming, but spring always follows. Position now, survive, then buy the ashes cheap. Your future self is counting on the version of you watching this today. Hit subscribe. Turn on the bell, will track every crack in real time. Comment your first move below. I'll pin the best one. See you in the next update. Stay sharp, stay solvent.